if you're not sure where all the links are, have a look at campaignforamillion.com. My campaign for $1 million to teach 1 million people how to be better investors. So do have a look at the campaignforamillion.com as well. And let's start sharing the screen. Let me know where you're from. Put it in the chat box. And especially if this is your first time on here. So sunny Auckland, morning. The alpha of all papas. Thank you, KP. Thank you, everyone else. Piet from Malta. Fulham. The amazing thing is, people have started telling me where they're from before I've even started. 10 p.m. I know, Jeffrey, Malaga. I apologize it's so late. But summer holidays, my son goes to bed late, and I do these after he wakes up. Sorry, after he goes to bed. Anna, Carl, Paul, Barry, Jugdeep, Mick, Fred, Lol, William, Sammy, everyone else. Welcome. You can see the screen. Let's get on with it. I've just been putting up a load of new screens on here as well. I'm going to be in Geneva soon. For those of you who follow what I do, we've really moved a lot of our operations to Geneva. So I'm going to be back out there. I've got a team there in the office, and so I'm going to be spending more time in Zurich and Geneva. But anyway, that's by the by. Let's remind ourselves of this. This is not a solicitation to buy any individual security, and it is not individual financial advice, for the simple reason that I'm giving you education information, talking to you as the public. I don't know who I'm speaking to, in other words, on the other side. So, should be able to see all of this. Now, this is a public redacted version. There's a private client version, just to give you this. Well, the war in Europe still continues. It was funny at the White House. You looked at the countries which were around there, and you had the Italians since the days of the Roman Empire wars. You had the French Empire, you had the British Empire, and of course, the one country heading the table is Donald Trump and the Americans. You might say American Empire. No. What I would say is the one that was colonized, and the French and the British were fighting over. Anyway, discussing Russia. No change. There continues to be a war in Europe, as there has been for 2,000 years. And that war is not about to stop, but it's not impacting the stock market. I'm going to focus on the stock market. It's not impacting the stock market. If anything, the reverse. The stock market continues higher. The only thing it seems to be impacting is defense stocks, based on whether or not you're gambling on peace or no peace. If you want to gamble on peace or no peace, go to Ladbrokes. Gold all-time highs, time to short that. Because statistically, the odds are more in favor of a fall rather than a rise, but I'm not a gold expert, so you can take that whichever way you wish in terms of gold. It is, not my speciality. India is playing it nice with everyone. They're not doing the Chinese strategy of sanctioning the United States, and they'll work with the Americans on what happens with oil. Okay, so the oil prices are staying quite subdued, which is good for us because it will. You've seen UK inflation is now edging higher. Figures came out. As long as oil stays within reasonable bounds, then the rest of the world is not impacted. The stock market's not negatively impacted, so that's good that the Indians are being nice. Ukraine, no peace, no Nobel Peace Prize, and Trump always changes his. Always chickens out. Or Trump always changes opinion. So Taco and the flip-flops continue. A friend of mine, Ashok Malik, has just written an article in the Financial Times on the damage of the American policy to Asia, and nothing new. We all know it. Nothing new has been said there. So this is not impacting the market. That's good news. Great. The stock market is one of those wonderful things where you can afford to be really, really lazy, and you don't have to be sort of on your fingernails sort of chopping away. The mistake is most people are on their fingernails chopping away, and they don't need to. S&Ps are all-time highs, and we're going to look at that in more detail, all of which is rather good. In fact, the stock market is the only refuge you have in peace and calm compared to the rest of the world. If you watch the news, you probably want to be it's probably half suicidal. Jitan from Leicester, thank you. Glyn from Workingham. Not as nice as Geneva. I don't know, Glyn. I fly into Geneva in the morning. Mid-afternoon. Have a breakfast meeting, and then I fly back. Zurich, I do a day trip. They're nice, but you know what's really nice is being at home. Raj from Leeds. I'm a homely person. Anyway, side issue. Now, I want to show you this. These are the dog funds. If you've got any of these, be worried. These are UK all-company funds. I'll just explain what they are. The 3-year return on £100 is 72. I don't mean you make £72. I mean you're down from £100 to 72. You've lost money. On the LNG Future World Sustainable UK Focus, you get, well, of course, it's bloody sustainable in the title. What did you expect? You might as well call it vegan or vegetarian fund. Well, let's go to Fidelity. UK Opportunities. These are busy opportunities. Fidelity is one of the best in the world. A person asked me, hey, surely you're not the cleverest person in the world. Why isn't everybody doing the same approach you're doing? And I said to him, well, we certainly know they're not, because Fidelity is there and you can look at their fund and that's down that much. And part of the reason that they get clobbered is this. 2002, they can't go into cash. They get whacked when those years happen. And secondly, it's just UK. I can pick from the world stocks. Those two things, one, I don't just pick from one country. And two, we don't get clobbered in negative years like that. Savers, the stock market is like snakes and ladders. Ladders goes up, 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 and up. Then snake year happens and it brings you all the way down. Those years are when the fund managers market like crazy. This we avoid by our daddy bear rule, which you'll know. I'll come to it in a second. So we try and avoid the worst of those falls. We can't time tops and bottoms, of course, but we try and avoid most of those. And then we climb the ladder again. In a 5-year period, generally, the benchmark index of the S&P doubles over 5 years. If there's a recession in the middle of that, if there isn't, then it might take less time, like 3 years. Okay, but what we're trying to avoid is that, and that's why these funds do poorly. So if you happen to have Octopus, and look at the words in here, opportunities. They didn't need to put that word in. They put it in for marketing. Okay, Eden Tree, you get responsible and sustainable equity. Well, I'm sorry, that is not responsible or sustainable, because over the last 3 years, the S&P alone has gone up and massively, and the FTSE's at all-time highs. So that's just rubbish. That's just rubbish. 3-year relative to benchmark, you're down 33%. The benchmark. Now, here's a little thing I'm going to let you into, because I've spoken to the boards of funds like these. They take a benchmark, and let's say the benchmark has 100 stocks in it, for argument's sake, like this. What they do is they get a little sliding scale. They say, well, we'll buy more of this one and less of this one, and let's see if we can outperform the benchmark. That's all it is. And yes, they get paid the big bucks for that. That's all it is. Yet they keep sliding those in the wrong direction. So that's it. I mean, AXA Framlington, they appear a lot on this. Basically, the rule is if it says opportunities on it, or if it's only UK or only US or only Australia, just be very afraid. Beware of these names: 91, Jupiter, M&G, NFU, National Farmers Union, Mutual UK Equity. The farmers, we all agree we love the farmers. They give us the food. No, not so much. The farmers are you know why the farmers are getting screwed? A lot of them will be in NFU. They're not just getting screwed by inheritance tax and all that. They're not just getting screwed by Tesco's pushing down their prices and saying to them, we want milk at pennies on the pound, and, you know, hard work, all the rest of it. My family has a farm. I mean, we don't live off it. Has a farm in India, and I know how hard work farming is. Not because I've had to do it or my family members have to do it. We've seen the people, they work hard. It happens to be tobacco. That is one of the key crops we have. So, you know, anyway, the point is that they're getting screwed on their pensions as well. So inheritance tax is screwing them, and their pensions are delivering nothing. In 3 years, they're down. You know who they should be protesting against? Not just Rachel Reeves. If they so wish, they have the right of free speech and protest. Bloody hell, they should be protesting against their farming fund managers. Anyway, Trojan income, at least it says Trojan in the title. At least you know that it's your enemy who's coming along as a friend. They have the guts to even say that. Horrific, isn't it? Now, let's get on with a bit more. I know, shocking. I'm going to show you some more stuff. These are our model portfolios, okay? Just some of them, not all of them. And that's not a benchmark. I don't care for benchmarks because what the hell's a benchmark? Benchmark is absolute return. Money's money. Can't go to Starbucks and say, listen, I'm up against the benchmark. Can I pay for it in the relative performance? They couldn't care less. But I want to show you the S&P 500, and I want to show you the FTSE All Share. Okay, these are just indices, ETFs, trackers. Okay, and this is how they've done so far this year. The index, okay, that's where they are. Last year, 24% up. The UK was 9. S&P 26% the year before. UK was 7.9. 2022, bad year. The S&P was down 18. The UK was flat. 2021, S&P was up 28%. So if your pension was in nothing but that, you would have been up 28% 2021, 18 in that, 31% then, down 4 in 2018 and 2017. Okay, and those are the FTSE All Shares going back to 2017. That's our quality 5 plus. Okay, just so happens. Now I want to show you something. We can't invent companies and defy gravity. Okay, that's 1%, that's 7. So just so you know. There's a bunch of others that we've got. And you might say, well, wait a minute, why doesn't that go into 2018, 2017? Because some of the companies that are in there didn't exist in 2018, 2019. Simple as that. And then you got UK ETFs. I don't like UK. We've created that just to see what's the best we can do, but I don't tend to like it. It's like playing football in a hurricane. It's just bloody difficult. So there's a whole bunch of others. Anyway, there you go. Quality 5 you'll be familiar with. Because I talk about it. It's in the public domain what my quality 5 are. The 2 M's and the 3 A's, Meta, Microsoft, Apple, Amazon, Alphabet. And that's if you did nothing, including that, and ignored daddy bears. That's what you'd end up with. Okay, even if you ignore daddy bears, you're going to get a heart attack and do. That's why we have the daddy bear rule. Okay. James, hello from Banbury. Thank you very much for being on. Now, this is Warren Buffett's latest portfolio. He has got out of T-Mobile. He's reduced slightly his position in Apple. Now, this is the bit where people sort of have a heart attack. They go, Buffett's out of Apple. He must hate it. No, he's not out of Apple. He's reduced the position. It's called rebalancing. United Healthcare he's got back into. Got into. I did a report for my clients on that. And then these are his other holdings. That's Chevron, by the way. That's Charter, and so on. That doesn't mean you go out and buy all of these. I, as you will know, happen to own Apple, but it's not. There's a student of mine who gets a bit of a heart attack if he thinks I'm talking to anybody, like jealous girlfriend, if he thinks I'm talking to people, the public. But that's in the public domain that I own that. Now, this is something I came across. I don't have any of these and didn't pick any of these. US shares up more than 200%. That's an important point I want to make to you, which is it's not my job to try and pick which ones are going to go through the roof. That's the job of internet, Reddit accounts and TikTokers and all the rest of it, and the fantasists with the crystal balls and the time machines. Warren Buffett, in the history of his life, has never, ever in his portfolio had a stock in a year where it's been the best performing in the stock market. He's never needed to in order to become, at one point, the richest man in the world. The point being, this is all nice for chit-chat and glamour, but that's not our job. If a stock happens to go up that much in a year, we've been very fortunate. Why have we been fortunate? Because it would mean we picked a stock which are in a very small minority. If we could pick these through the power of quantum computing, AI, and Grayskull, I would pick those. Our job is to select companies based on our approach, and if they happen to do really well, that's fantastic. But we're looking for resilient companies. Think of it like this. We're looking for companies which, and while I'm talking, you can read this from Goldman Sachs and the survey question and what people have said. And most people have said they're either adding to the Magnificent Seven or holding on to them. So there's not much selling pressure coming in the market. And you can assume that the people talking to Goldman Sachs are both telling the truth and are not lying to Goldman's and have money, so it matters. So when we're looking at, just go back to this, companies, I want you to think of it like this. If I've got in my portfolio, my son or my wife's portfolio, I'll talk about some of the stocks that I've mentioned before that I own, which you'll know. Then what will happen is I treat it as if, let's say it's Microsoft, and we fly out to Seattle tomorrow and we go to the board meeting. I sit around the board meeting and I see them all talking about their strategies for Trump and AI and quantum computing and what they're going to do and where the sales are. I'm not going to get up and say, listen, I'll tell you what I think. I'm going to keep my mouth shut because they all know more than I do, both about their business, and all they do is think about it. The point is, as a capitalist, when you buy shares in a company, you own that company. When you own that company, either you own it and keep your mouth shut, or you own it because you think you can do better than they're doing, in which case, start your own company. And let's assume if you're buying shares in somebody else's company, you probably can't do better than they're doing. Otherwise, you would have created their company anyway. And that's me. I can't do better than any of the companies that I've bought shares in. So I let them get on with it. And if I think they need a bit of my help, I won't buy their bloody stock. Because if, like Groucho Marx said, I don't want to be part of a club that had me as a member. If they need me to help them out at Microsoft, my God, are they in trouble? Okay? Or whichever stock I own. And that's the attitude I take towards them. The point being that the kind of companies that I have are the ones which are undervalued, growing. In other words, lots of earnings for their share price, growing profits and revenues. And if that isn't obvious to you, why you want companies with lots of profits for the share price to earnings, for instance, and which are growing in revenues and sales, and you think, well, and profits, you think, well, why does it matter if a company's growing or not? And growing profits. Why? Because the world cares about profits. Okay, just for as long as the world cares about money, they'll care about profits. And as long as they care about profits, stock prices will eventually go up to match those. If you want to speculate, that's different. What about investing? Okay. So we're picking resilient companies because I don't know what the future holds. What people think is that the companies don't matter. Your job is to look at the future and guess what the future holds. No, that's the exact wrong thing you're looking at. Only the companies matter, and what's going to happen in the future is irrelevant. You can't control it. So what do we know about companies? We know people care about profits, so that bit matters. We know also that other things can move stock prices, but we're not looking for those kind of other strategies. Okay, we're not going to get distracted by the fact that if somebody at the Oval Office and the White House tweets something, a stock might go up. Well, our strategy is not based upon trying to inseminate ourselves inside the brain of, or any other orifice leading to the brain of, Donald Trump. That's not our job. That's the job of other world leaders, okay, to secrete themselves inside the man. Even though that strategy might lead to stock prices moving up, our strategy is value growth, income, cash flow, Sortino, alpha. Okay, it's those. Now, do those things work? Are they important? How do we know? Well, I've put a load of the literature, academic literature, on that, on the free materials that I have, all the academic material, and in my books. Okay, and the people that I've relied on for all of that research and data include Richard Thaler, Daniel Kahneman, Eugene Fama, all of whom went on to win the Nobel Prize in Economics. So if you buy any of my books, and I'll give you copies to download, actually, I'll do it now. Files, copy of the book, where I've discussed all of this anyway, one of my books. Here we go. There you go. All right, you should be able to download that. Right. This kind of stuff's really important to know. Now, I also want to share with you this I came across. History shows bull markets last far longer than bears. Thank goodness. In other words, it's like having a coin that you're flipping. And Eugene Fama, who, as I said, got the Nobel Prize in Economics, I think it was in 2018 or 2016, somebody can look it up. He said this, and it's really important. It is like flipping a coin, but a coin that's biased to the upside. Now, if you flip it once and you come up with tails, you might say, oh, bloody hell, stock market's rigged, or this company's rigged. In other words, if you give it more time, it should be more beneficial to you. But that doesn't mean you pick any old coin, any old company. You want one which has got the best odds of having more likely to come up heads than tails. Anyway, if we're just looking at the S&P, which is the tailwind, it's the tailwind. It's like flying from New York to London. If there's a tailwind, same plane, same pilot, you get there sooner. Headwinds, same plane, same pilot, same route, you get there longer. In other words, recession, headwinds in the market, can't control them unless you can control the flow of air across the Atlantic, which I'm assuming you can't. The markets are the same, so we can only pick on the pilot and the aircraft. In others, we want to pick the most resilient companies. That's all we're doing. Do you understand the mindset? Okay, because the mindset's really important. Anyway, this I just thought was interesting, just about bull and bear markets. Lots more blues than reds. If only time could move faster. If only time could move faster and we get our returns sooner. This I thought was interesting. Morgan Stanley outlook for global equity indices. There we go. Somebody said, seem to have an issue getting sound, tried reconnecting and also can't get full screen. Is everybody else okay with full screen and sound? Full screen I probably couldn't help you with. That might be at your end rather than mine. Try a different browser. such as, Chrome, I think works, and Microsoft Edge works. If you're using something rubbish like Safari, you might be in trouble. But Chrome and Edge work, Liam. So do try that. No, Paul said everything else is okay. Now, so browsers are usually the issue, I'm afraid. It's usually not us at our end. Now, Morgan Stanley forecast, mid-2026. This is what they think. The current bear case, the bear case being they think worst case scenario at Morgan Stanley minus 16%, minus 26. Oh my God. Imagine minus 26. Base case, they think that. Bull case, yummy. Where am I sitting on that regarding by so a year from now, 12 months from now? Oh God, it would be easy for me to say, I'll go with the base case. My point I want to make with you is this. I'm not gambling on whether it's a bull, bear, or base case. What I'm saying is, whichever ones of these it is, particularly if it's the bear case, I don't mind. I wish I win the lottery. But the fact that I won't, I don't mind. And that's the attitude you have of the market. As long as you've got the good quality companies, that's fine. Now, if you want to gamble and speculate, you can go to Ladbrokes and say, I think it's going to be one of these three outcomes. If you want to be an investor like a Warren Buffett and eventually the world's richest man, then you say, well, whichever one of these three things happens, I'll be fine because the kind of companies I've selected, not that they'll all go up, but they're resilient. And if it goes up here, on a bull case, I'll make more with my companies. And if it goes here, I'll make less, but they're still companies I don't mind holding. That's the attitude. David said, I'm using Edge and my screen and sound is regularly freezing. So it might be Edge, Microsoft Edge might be a problem. Apologies for that if it is. I'll see if I don't think I've got unnecessary things on at the moment on my screen. Sometimes I have background operations. Quit Teams. I'll quit Microsoft Teams. That's probably, those kind of useless background operations, which can sometimes be on. Okay. Close window of WhatsApp. Not that it'll close, I'm sure. Anyway. So that's where we are with this. Year-end forecast S&P 500. Now, here's an interesting thing I want to show you. Okay, these are all the major banks. Okay, let's take Goldman Sachs, for instance. Now, that's the 2025 target. This is what I love. They get to change their targets. Hang on, I think they've got a time machine. What do you mean you can? That's like saying, yeah, I don't think I'm going to do this. Well, I think I'll do different. Anyway, this is what they think on average. Guess what? David Costin probably went to the same universities as any of these other ones. And here's the interesting thing. They probably all worked at each other's offices anyway before they ended up wherever they are. And I'm not going to gamble on which one of these is right. I've just got to buy my stocks. That's the point I want to make to you. First of all, they have such wide differences of opinion. I mean, blimey heck. You got one at 4.4 there, and you got another one at, what's that, 7,000? Okay. And they keep changing their minds. The point being, I'm sorry, I'm not there to throw darts at a dartboard and try and work out who's right and who's wrong and which one of those. I'm not gambling on any of them. Why do these people therefore exist? And why do they have a lovely title like strategist? Marketing. It's their job. Imagine they didn't have, imagine Barclays said, we don't have somebody who has forecasts on the S&P because we think it's all bullshit. Well, then clients would probably leave Barclays and say, bloody hell, they're smoking the wacky tobacco. Let's go to JP Morgan, Goldman Sachs, and Morgan Stanley, who are a bit more conventional. Okay, and don't come to me and say, no, let's just look at who's regularly accurate. Well, that's a pointless exercise as well. Instead, what I recommend you do is none of these things and just buy the resilient companies, which I'm going to show you how we do it and why. So we don't care what the analysts think. They might be right, they might be wrong. That's not a game we're playing. We're not here to play the game of, Chetan says Safari is okay. Rubbish Safari is working great. Sorry, David. Apologize. Normally we have most complaints about Safari. I take it back. Edge is letting people down. I don't particularly like Edge. So apologies to all those on Safari. See what I did there. Now, keep calm, carry on. Since World War II, most military and terrorist shocks have had a limited long-term impact on shocks. You might say, what's a terrorist shock? Well, don't ask the BBC the definition of terrorism. But that aside, Okay, 10 of the most recent events are listed below. Okay, military and terrorist shocks. I didn't write this. These people did. So don't say to me, wait a minute, I don't think the bombing of Syria was whatever. It is there. Okay. And first day of reaction, negative. 30 days later, not so nice. The 60 days, not so nice. After 90 days, you're laughing most of the time, with the exception of, well, I doubt that was the reason anyway for the market. General Soleimani. Does anybody even remember when Soleimani got assassinated in, where was he? He wasn't in Iran. He was an Iranian general, but I think he was abroad. I think he was in the United Arab Emirates. I think I might be wrong. Or Syria or Lebanon. I think Syria or Lebanon. I forget which. Anyway, clearly irrelevant to the market anyway, I would have thought. And that probably had more to do with COVID. But that aside, the point being, keep calm, Karen. Again, if the companies are resilient, the external events are irrelevant. And what a lovely world to be in where we can ignore politics. Wouldn't that be nice? By the way, since Trump got elected, coincidence, causation? I'd probably say causation because he's obsessed with it. This is Bitcoin. It's up 65%. Can you believe it? It's up 65%. Why does that say 65? Oh yeah, and the peak was 77%. So it's up 65. It was up. I'll let you some insights into his. They're very pro crypto, in case you didn't know. And there's a chap. A lot of them that he's appointed in government are an Anderson Horowitz. You might know he is nepotistic to another level, in case that had passed you by. In other words, friends and family all getting hired. Anderson Horowitz are a major American private equity firm, arguably the best, alongside Coastal Ventures and Sequoia. Anyway, they had a chap who had moved to the UK to head up the UK operations recently, and my wife was working with the chap who'd moved over here. And Trump got elected. That chap went back, and Trump said to him, "You're going to be my head of crypto policy." At which point my wife said to me, "Bloody hell, Trump's really pro-crypto, isn't he?" And this is all in the public domain, other than the bit that the guy worked with my wife. But one thing which is in the public domain is, my God, they love all of the crypto. Now, I'm not a crypto expert. I know as much about crypto as I do about modern art. I know a little bit about modern art. The point being, it's like modern art. 10 years might be worth a lot, or it might be toilet paper. Okay? World stock market returns. I'm talking about modern art and crypto. World stock market returns. So I want to look at this and show you something. And I know I keep banging on about the US markets. And 10-year annualized return, 15.6%. That's just the tailwind. That's just the S&P index. That's just the tailwind. What's the tailwind on the UK? 6.2%. Pretty close to inflation, to be honest. Okay, there's the FTSE. That's from JP Morgan Asset Management. It's not good. It's not good, is it? That there are years when the UK's done better. But generally, that's where it is. And everything else in between. Now, your IFA wealth manager will try and sell you all of these on the basis that they'll say, well, you never know which is going to be top dog. Okay, fine, if you want to do that. But generally, you'd be worse off than if you had one of them. And we know which one. I'll leave this for you to read before we get onto the S&P 500 charts and the individual stocks, which I want to show you now, and how things have gone. Chicago, Bruce from Chicago. I love Chicago. Chicago. Anyway, the commandments. Let me pick a commandment each week to go through. Let's pick I'm not going to go through all of these now. Let's pick the drawdown curse. I'll put this up each week and I'll pick a different commandment. As soon as you buy a stock, it will have the worst drawdown it's had in recent years. Get used to it. Now, the reason that commandment's really important is this. You can never get disappointed. It's a win-win commandment. If it doesn't have the worst drawdown, you're happy. You expected it to, but it didn't. Drawdown is when something falls from peak to trough. So you buy it and it goes down the worst. Okay, that it's gone down. Let's say something goes like this. What's a drawdown? That's a drawdown, peak to trough. That's a drawdown, peak to trough, okay? And let's say it does have it. Well, you still win because you expected it. The problem with private investors is they panic because they think history won't repeat itself because they think they've got a magic account and that when they buy something, they've got diamond hands. And when they've bought it, the world revolves around them and it can only ever go up. That's what leads them to gamble, speculate, and panic. Don't do any of those things. Commandment number 1 over here will save you a fortune. We'll go through the others in future weeks. Now, see this. I like this. Effort, value. This is Warren Buffett. This should be all of you. Sadly, retail clients go for this, which is why they mess things up. It's why they get bored with their portfolios and why they think that every single one of your stocks didn't go up. Warren Buffett's never had a year where every single one of the stocks in his portfolio have gone up. If the greatest investor in the world ain't going to do it, you ain't going to do it. All right? I ain't going to do it. Okay? That's not what we're trying to do. What we're trying to do is be here, and that'll make us the richest person in the world. Trying to do this, which is what retail clients do, just won't. Okay. Oh, thank you. Peter said using Edge, and if you click mouse when it freezes, all comes back. Okay. Oh, so it might have some kind of setting to reduce the use of computer power. And it assumes that if you've just got a browser open, they should put the browser on sleep mode or something. So anyway. So yeah, Edge is a problem for David. Oh, he said I'm using Edge and it's a problem. Edge have just recently, by Microsoft, just announced a new upgrade, which looked interesting at first. And it does all these clever things and, like has Copilot and all this. And as soon as I tried any of it, the number of logins you had to go through and everything else, if you've got a business account, oh my God. And then I delete. Smart ass engineers. These are 10 of our model portfolios. We've got lots. I want to show you something interesting. First of all, let me just familiarize you with what we've got. So here's the annualized return on average, okay? And it goes back to, in some cases, 2011, in other cases, 2017. The reason that's important is because it also includes the awful periods. They've been stress tested on periods like 2018, which was a really bad year for the market, and 2022, which was an even worse year. So what we've assumed is, like crash testing a dummy in a car. We said, here's a car, it works well. And you might say, well, how do I know it can survive a crash like 2022? We said, well, we put it through 2022 and it still produced these annualized returns. And you go, oh, okay, I can survive a crash then. Same principle, okay? So all of these went through that. Now, here's something I want to show you that's important. Maximum drawdown. Okay, this is really, really important. You understand this for your pension and your portfolios because it'll stop you making basic mistakes. Okay. The drawdown is, imagine this is your portfolio. It goes along like this. Drawdown, as I said, is that period to this. It's the biggest drop in the value that you could see from there to there or from here to here. So you might say one day, wake up and go, ooh, I'm at 150, darling. Let's book the private island holiday. And then let's say over the course of a period, it goes down to 120. Well, the drawdown is 30. Okay. So you want that to be minimized. Why? You might say, well, that's irrelevant, Alpesh. And it is irrelevant, the drawdown, in many regards. Because, and this is really, if I tell you nothing else on this webinar, listen to this bit. The reason is this, and Warren Buffett puts it like this. If somebody came to you every single day and told you the price of your house that day, you'd probably go mad and punch them in the face, but also it'd be irrelevant, wouldn't it? You'd go, oh, the house is down now, darling, 1% compared to yesterday. Okay. And let's say a year later, he comes to your house and he goes, you're down 10%. You wouldn't say, oh my God, darling, our house is down 10%. Let's sell it. And Warren Buffett says, this is what people do with their portfolios. It's irrelevant. You plan to live in the house, hold it for longer. What do you care what the daily price is? And yet you look on Bloomberg and CNBC or whatever, and you keep checking the daily price and you panic. So in a way, drawdown's irrelevant. When is it relevant? When it's the last year before you're about to sell the house. Then it becomes relevant because you don't want to be down a lot. Okay, you don't want to have saved your pension for your whole life and all of a sudden you're down 20% because the worst drawdown it historically has ever had hits you. Other than that, drawdowns are irrelevant. And the longer the period you're going to hold something, probably the higher the drawdown number you want. Why? That's odd, Alpesh. Why would you want higher drawdown numbers? Because they're inherently linked to returns. In other words, risk is linked to returns. Oh, well, thanks for pointing that out. Well, I put it in a different language to you. Now, here's the important thing. Look at this. Look how it goes in that line. In other words, the bigger the drawdown risk, the greater the return. Well, thanks, Alpesh, we knew that. I would love to give you something at 44% return with only a 10% drawdown. I can't create it. Bloody difficult getting this. By the way, each of the portfolios are named after clients. They're not. This is the interesting thing. I could have given them great names like Rocket Fire, but instead we just named them after clients. Anyway, I want to show you something else. You might say, what the hell's a Sharpe ratio? Well, actually, it's a measure of risk to reward. There you go. You want that to be as high as possible. But you might not want it to be as high as possible because you might say to yourself, hang on, I don't want the Dinshaw portfolio, even with a 1.9, because I don't want that drawdown. I know I'm not going to sell my portfolio tomorrow morning, but I just don't want something which is that volatile, like Tesla stock, for instance. Imagine a portfolio equivalent of Tesla stock. You'd be bloody worried, wouldn't you? Okay. So anyway, that's where we are on this. And I just wanted to show you that and what we're trying to aim at and how even we, with all the things we do, cannot escape the gravitational pull of risk and reward. It has to be this line. I wish I could draw things just up here. Okay. So I want to show you something else. That's the Quality 5 Plus, 2017 to 2025. Okay. So it's a model portfolio called the Quality 5 Plus. 44 stocks, and that's what it looked like. Now, I wish it was higher than that so far this year. It's out of my hands. Okay, I wish in 2022 could have done better than that. Out of my hands. 2018 was a bad year. That's the crash test dummy of real life. That happened in real life. The markets were that rubbish in 2022. This is what happens if we did nothing and we crashed into the wall. Now, we have a rule about daddy bears where you press the brake and all the rest of it. We just assumed we didn't. We just kept driving into that wall of 2022. I.e., what happens to this car? If that was people, the car manufacturers go, well, wait a minute, that's a bit unfair. Nobody ever crashes into a bloody wall, but you're making us fit it to that standard. Yeah, I think it's quite a good analogy and to do it that way. Okay, and by the way, there's your S&P returns. That's all they're bloody nice. By the way, the past is no guarantee to the future. Now, that's not just a regulatory statement. Tomorrow, Putin could bomb the world. If you start thinking the past is a guarantee to the future, you're speculating and gambling. You know good, damn well it's not a guarantee. Put another way, that's what we're really after. That's the Quality 5 Plus. That's what we're really after. But there's many other different models. Now, if you try and get that below 10%, this takes a disproportionately big hit. Okay? Now, the way to look at it is this. Forget that. Halve that. Put that at 15%, which means halving that and double this. So the drawdown in future goes up to 26%. Again, you shouldn't care because the drawdown is something which, it's like your house price. What do you care? Okay? Unless it's the year before you're selling or 2 years before you're selling. Okay? And there's the return, halve it. What does 15% mean? It means you double your money in 5 years. Is it guaranteed? Of course not. Nothing's guaranteed. That I'll be here tomorrow isn't guaranteed. Now, here's something else I tell my students to do. Look at every single year and look at the returns on each year. Forget those for a second. Look at so this is individual stocks in there, which I've obviously redacted because otherwise one of my students, Dippin, let's call him Dippin, will have a heart attack and say, why are you sharing confidential information? But this is what you should always do with your portfolio. You should ask yourself, well, wait a minute. That's a year in which one stock was down 64%, another was down 28, another was down 26, 49, 39, 50. Oh my God. Or as Warren Buffett put it, if you can't withstand a stock that you hold going down 50%, you have no business being in the stock market. The reason I tell them always to circle the reds, and we break this down month by month, stock by stock, is so they don't panic or get bored. Panic and boredom are the two things which could kill and stop you from getting that return. This is the return. That's the breakdown of the return. So there's no argument about history. It's not, well, you know, it's a history. It's all open to interpretation. No, these are actual bloody numbers. And when you see the numbers, look, they're there, but that entails a 64% drop in a particular stock within that portfolio. It involves a year which was rubbish. So how do we weather those years? Well, either we use the Daddy Bear rule and just hold cash in those years, which is fine. I'll show you the Daddy Bear rule later. I've shown it on public webinars. It's in the public domain. I put it in every single one of my books. But, or you hold through it and you say to yourself, well, I'm not going to panic, and I'm not going to get bored by rubbish returns either. I mean, look at 2018. It was 7%. Many people would have got bored and got out of the market, and then the next year is up 42 bloody %. They got bored. Or they panic. Panic and boredom are the two things that'll kill you. You can only do that if you've got quality companies, 44 in that case. I also wanted to show you this. See that button there? Whenever you go online to any SIP or ISA provider, any pension provider, they always have this button on their websites, transfer now. So I just wanted to mention, this is not an advert for free trade. It could be Hargreaves, Lansdown, Barclays, whoever, Halifax, whoever. I wanted to mention that because a lot of people don't know how to take control of their pensions. You can transfer it to a SIP, which is a pension you control. So you control it all on an online account, okay, with many brokers. Like I said, Barclays. And why do I always mention Barclays? Well, because it's a name everyone's heard of. That's why. So I just want to let you know, if you don't know what to do, and I'm coming to the stocks in a second, then this is where most of you will be. You'll be one of these two. And here's what that means. You'll either average in accelerated or traditionally. And here's the downside of each. Now, why do I say that? Well, because I don't have a crystal ball. I can only tell you in hindsight whether it would have been a good idea to buy all of NVIDIA today, or to wait a year, or to average in each month, or over 2 to 3 months. Because I don't know what the future holds, but I do know it's a quality company. I say to you, all you can control is your appetite. And based on your appetite, do these things. That's it. Okay, that's it. So that's where we are. And then we've got this. What do I do with my portfolio? Again, I like flowcharts. So with my students, we just do, if it's a model portfolio, are they in line with historical moves? Yes, then no need to be bored or panic. If, and some of my students prefer the filtered list, I say 10%, which is individual stocks, 12 months, 25% drawdown, they exit. Now that requires a lot of wanting to be controlly on top of things. The risk with that is 12 months might be too short. Obviously, that's the risk. And the obvious other risk is 25% might be too small. So model portfolio removes that. But then if you want to be more in control, then you can do that. Now, I like flowcharts. Create your own flowchart. Take a picture of this. Copy it if you wish. Now, where are we at the moment? Now, I first published this publicly and for my clients. So it's in the public domain, and it's nothing new because I've been doing it since my days of doing it. I've done about 300 shows on Bloomberg TV back in the day, and I'm using the same principles. And this is the S&P, but it can apply to exchange traded funds generally and the Quality 5 Plus. It can't apply to other stocks, okay? But it can apply to exchange traded funds, indices like this, because of the nature in which these things are constructed, and the Quality 5 Plus, the 44 stocks, which are in what I call the Quality 5 Plus. Anyway, the general rule is this: 1, 2, 3, 4. So when we were at 2 to 3 there, I said that we're at 2 to 3. Where are we at the moment? We're somewhere between 1 to 2 on the markets, okay? This is going back to, when is that period? When is that? Whoops. That is, whatever that is. What's that? March? So in March of this year, we were at between 2 to 3. Now we're at 1 to 2. What comes after 1 to 2? Well, 2 to 3 comes. So are we going to get this fall again that we had before? We might. And by the way, what do all of these mean? You can take a picture of this. 1, 2, 3, 4, 5. Now, my student who's going to have a heart attack looking at this isn't the public domain. It's been there in my books with donkeys. Okay, so don't panic. But that's where we are. So where are we on that? Well, let me show you exactly where we are. This is bang up to date where we are. This is the daily chart, okay? Daily chart of the S&P. We're up here. And that's very similar to here, where we had these dips, and here, where we also had these dips, and here, where we get these dips, and here, where we get these dips. Okay, so we'll keep an eye on it, but all I'll say to you is that's where we are. I'm not going to overinterpret that. What I'll also say to you is September is the worst month. So there might be some nice opportunities coming in September to buy dips and buy markets. That's all I'll tell you. Do I know any more than that? No, Donald Trump hasn't told me more than that, and he controls the markets, doesn't he? So let's go on to some more stuff about the markets. Well, these are the earnings that are due to come out. This is Wednesday after market close. None of these are going to move the markets. Okay, we're sort of in the off season for earnings announcements. Good big companies like Walmart. Interesting before market open that it'll have its earnings, but it's not going to. But this is the important one. That could give us some good indications. Okay, that's pretty important. Nvidia, in case you didn't know, they've got their earnings on Wednesday. I expect they'll continue knocking the ball out of the park and everybody will be very happy. But we're not gambling on earnings. I don't gamble on news and earnings. Past week, it's been down. Broadcom's been down. A lot of the chip stocks and tech companies have been down, but the softwares have been doing well. Healthcare has bounced back a little bit, but that's a week. A week is, let's put this into context, is noise. A week is noise. You will know, because I sometimes drip into these public webinars, some of the things that I own, which are already out there. You will know I own JP Morgan and Goldman Sachs. Did I know that this week it's down 0.75%? No. Did I care? No. Where's Goldman's? Oh, down nearly 3%. Did I know or care? No. So I want to teach you those things. Okay, I want to teach you those things, and that's the way to look at it, because I'm not trading them. I'm holding them for the longer term. Past year has been rather good, though. Now, here's the interesting thing. As you will know, well, I'm going to come to Apple in a second, actually. The past year, thank you. Okay. Now, that one's been a laggard. That's produced a ton of profits, which have gone from the P&L account, the profit and loss account, onto the balance sheet, because that's what happens to profits at the year end. They go from P&L to balance sheet. And that means that its balance sheet has got fatter. It's got a lot more assets because it's a profitable company. But the stock price has not moved. Well, hang on, that's like having a vault with a load of cash in it, and the amount of cash in that vault has increased, but the house price hasn't changed. Somebody's just put a load of gold in my vault in my home, and my price of me selling my home has stayed the same. That's what's happened with Apple. So there we go. That's one way to look at it. But we're going to do more analysis than that, obviously. Yeah, I continue liking it. That's too volatile for my taste. These are overbought, but there'll come a time when we get back into Walmart and Costco. It's just not right now. Okay. I did a note for my clients on United Healthcare, a very detailed note actually on United Healthcare, which Warren Buffett just bought into. So where are the markets over the past year? The Nasdaq's up 20%. Okay, over the past year. But here's the thing: the market, as you will know, does one of four things. Okay, it can do one of four things. It can either go up, which is what everybody loves and likes, but there are three other things it does where it's not going up. It can either go up and then fall back down, it can go down, or it can go sideways. Guess what? Those three other things, 75% of the time, it's causing panic or boredom. That's why people mess it up. 75% of them just panic. That's why I do these weekly broadcasts, to handhold and mentor and inform and educate, and hopefully entertain a little bit. That's where we are with these over the week. Well, they went up 16% in just 7 days because of the Buffett thing. And I guess the tailwind helped these. A lot of the healthcare stocks got beaten back because of Trump. So that's where we are with that. Intel's been in the news. I did a little note on Intel, a funny note for clients on Intel, what my 7-year-old son would say. Very high risk still. It's speculative. Okay, so if you want Intel, up to you. Burning cash like crazy. Probably needs a government bailout. It's a gamble. And you might say, well, thanks, Alpesh, for pointing out the bloody obvious. Yeah, sometimes pointing out the obvious is important. If you want Intel, go for it. It's a gamble. Far more of a gamble than, say, an Amazon. Might do better than Amazon, but it's a gamble. Not for me, thank you. UK stocks, I'll do a separate webinar on those. NASDAQ, where are we? Very similar to the S&P, unsurprisingly. Okay, so we are overbought. What's going to happen? Well, of course it can do this. It might do this. If it does that, i.e. short and medium term prices start doing this, that's called a daddy bear. If that happens, I may well go into cash. I might. We'll decide. one way in which I make decisions is I say to myself, do I need to decide today? No, then I won't make the decision today. Okay, it's as simple as that. Sorry, pardon me that you could hear me drinking water, but I needed to because it's a long webinar. FTSE 100 all-time highs, but in April we were back to 2019 levels, which looked like a bargain then, didn't it? So all-time highs, would that trudge along? May well do. Looks like it will for now, even though it's up here and could have little dips. I'm going to show you something about risk. Drawdown depth, peak to trough, that's the drawdown depth, and that's your duration to go back to where you were. Depth times duration equals risk, okay? Also equals ulcer index. The bigger the drawdown and the longer the duration, that's the longer you're going to have an ulcer. That's not too bad. Exchange traded funds, including index trackers like this, tend to have fewer ulcer causing characteristics than an individual stock like Tesla. Well, thanks, Alpesh, for stating the bloody obvious. I just thought I'd tell you. So look at drawdown depth, historic drawdown depth. I tell you what's good for this. Yahoo Finance and Google Finance websites are exceptionally good. They could actually charge money, but they don't. They're free. Occasionally, this is for high-risk people only, such as myself. My son and my aunt, whose portfolio I control for her, have this, just so you know, okay? And amongst others. And what I would say to you is it's not for everybody else, because that can go from 2,500 to 1,000 in the space of a year. You do the math, that's losing more than half your money. So we can still apply the daddy bear rule to these, which is as soon as you get that crossover, you want to get the hell out of there. And if this is flat to rising and this is rising, that's the earliest you'd want to enter. That is not relevant for any of you on here because it's too much risk. But it's all right for people like me, and I'm in that. Okay, so I occasionally will disclose other things that I own. My son owns it. It is not suitable for anybody on this webinar. How do I know that? Look at that drawdown and look at that duration. That will give everybody else an ulcer. Even though I've given this rule, it will give everybody else an ulcer. This is the same as buying Bitcoin. Okay? Ulcer. Now, guess what will happen? Private investors, being the nature they are, they will go for the risk. They're like moths to light bulbs. They go for the riskiest things. They can't help it. Now, Apple, for a very long time, I said, a hell of a long time, well, I say months, that unless this is rising and that's flat, that's the earliest I'd get in. So that's the earliest I'd get in. Now, I know one of my clients is going to have a heart attack that I've disclosed this. It's a little bit of teasing information. That's the earliest I'd get in. Okay? You could have stayed in all the time, but it's the earliest. Now you might say, well, what about here? I said, well, I told you before, I'm happy to call the bottom in Apple when it was down here, but I'm going to wait until this is flat. That's rising. So where we are. Well, does that mean it's only going to go up? No, it doesn't mean it's only going to go up. You're buying when Warren Buffett sold back. Well, he rebalanced because he made fat profits anyway. Novo Nordisk, no, that's still falling. Sorry. I know it's fallen off a cliff. I know it has a habit of going up. I have no doubt it will do that again. I called the bottom there, but I'm going to wait. Okay. This is how you sack your St. James's Place financial advisor who's been getting very poor returns. Take a picture of that. You can use that as the language on how to sack them. Okay. On that. Now, I want to show you something else. This is the approach. This is essentially the approach in one line. We're looking for companies which are undervalued, not just value stocks, which are generating income, because we know statistically, we know from the academic literature, they tend to do better. That's our sweet spot. Okay? And their growth. Now, if you're a fund manager who only has value stocks, then you might have companies which aren't growing. If you're a fund manager who only has growth companies, then you might have companies which are overvalued and crash. If you're only doing income generation, then they might be overvalued, not growing, so they're rubbish. That's why we play here. We put all the stocks in, and then we say we'll divide the money equally, let's say, to keep it simple, between 20 companies. Well, on that rule, you could put a stop loss on each one, and you're limiting the impact to somebody who, even if they had a 200 million portfolio, we've looked at fund managers with 200 million in their portfolios, most of their risk comes from their top 10 to 14 positions. In other words, they have the same risk that we do, because most of their money is in just a few companies anyway. So you've got a pretty stable downside, not high turnover. That's essentially it. That's it. That's it summarized. Okay, I just thought I'd share that. How do we do that? Value, growth, income. You look through 10,000 stocks and exchange traded funds. You want croaky, you want value, growth, income, you want momentum. Now, if you want high dopamine hits, then trade. Go for momentum. Go for a newsletter tip sheet, which will say, 10 stocks you must own now. You know, I'm not having a heart attack. I'm showing you what breathless headline and journalists say. I didn't come up with that phrase, breathless journalists. Warren Buffett did. You know, we laugh at them. But the tip sheet business, it's there. If you want that kind of dopamine excitement, I'd suggest you go to the pub and ask the hairy bloke next to you tonight who you don't know and say, what stock do you like then? Or go to a black cab in London and ask them. It'll be just as good. I prefer going through 10,000 equities, looking for undervalued companies which are growing with dividend deals. Cash and capital invested comes from Goldman Sachs Wealth Management. Your companies in the top quartile generate 30% per annum as a basket on average. So we want that green. Momentum comes from the hedge fund industry. Sortino is the high average returns versus low downside risk. Now I'm going to tell you something incredibly important for which somebody got a Nobel Prize in economics. Okay, imagine this is time. Okay, and this is return. And let's say you've got two stocks, and stock A goes like this. Okay, it moves roughly like this. And stock B sort of does the opposite. It rises when the other one's falling and falls when the other one's going up. So on average, they've both gone up in period T 10%. So that 10% is their return. Now, stock A has a certain volatility, it goes up and down. Stock B has a certain volatility, it goes up and down. When you put them both together, say you put half your money in each, they've got zero volatility in the sense that they go up 10%, other than they go up 10%, they go up 10%. But there's one cancels the other out. I mean, I know my drawing is rubbish, but assume the drawing was perfect. One cancels the other out. Nobel Prize in economics, that. I think it was William Sharp. I might be wrong. I've forgotten. If it is not him, it's someone else. In other words, what you're looking for are companies which have a lack of correlation. You might think, well, no, inversely correlated, yeah, ideally, but lack of correlation between each other. And that's how wealth is generally created amongst the JP Morgan private banks and all the rest of it. They're looking for uncorrelated assets. Anyway, our goal when we put all this together in a model portfolio is to get as close to this as possible, not with two stocks, obviously, but with as many as 40 using mathematics. Now, sadly, the past is no guarantee to the future. The same caveat applies. Anyway, this was 2024. Now, let me tell you something. Did I expect that? No. I did not expect something stupidly large as that. Not because I'm a pessimist, I'm not. It's because that is outsized. So what was the reason for that? It's not anything to do with me, my friends. It's because there was a tailwind in the market. And did we cheat? Yeah, we could afford to cheat. We had that. Okay, we had that. So did we cheat? Well, you could say, well, it's not fair, Alpesh. You did that. Well, yeah, okay, fine. But why didn't wait a minute, why does that say 150% and that's only 41? Because guess what? There were a bunch of stocks which did a lot less than 40%. Think about it. If that did 150 and that did 515, and if we were clever, we'd only have put all our money in here. So let's get some certain things right. One, we weren't so clever as to only pick one company. This is going back to January picks. I mean, if you did from March to March, it wouldn't have looked as good. Just so it happens the calendar year coincided with our good fortune that the January selection for 12 months looks rather great. Okay. But there were a load which were at 0%. When you take the whole portfolio together, it averaged that. If we were clever, we would have just bought that. We're not that clever. We don't have those kind of crystal balls. That's why you have more than one thing in your portfolio. What is it we're trying to achieve? Well, this is where you might say, hang on, if the market itself is giving you 15% and you're doubling your money in 5 years, because that's the maths of it. Okay, you can see it here in dollar terms, in sterling terms, that's 15. why are you bothered about trying to get from there to here? Why are you so greedy that you're trying to shave off a year? It's just greed. That's it. It's just greed. Okay. What we're trying to avoid is be higher up. Oh, that's the end of that. Let me answer any questions that you might have. Oh, I forgot to ask you all. I forgot to do a poll. There's a poll. Let me just start the poll if I can. And let me put the screen back up. There we go. And answer any other questions that you might have and put the poll up there. For those of you, and I kept it to exactly 1 hour. I'm trying to keep these things to 1 hour. Okay. Anything you want to ask me at all, feel free to ask away, and I will try and answer anything, any questions that you might have. But that's the video for this week. And there were no new purchases this week other than the one I just mentioned, Apple, because as I've said previously, when it shows the position it's now showing, I would get in. There you go. Okay. Any other questions? Otherwise, I'm going to send some files to you as well. And by the way, for those interested in the Great Investments Program, I'll also, oh, there's the poll. How will the FTSE do? I'm also going to put that up for you. I give a 40% discount on the webinar. So for those of you not familiar with it, that should be on your screen now. You should be able to see. And oops, I'm going to show something else on the screen now. And sometimes, annoyingly, on these things, people ask me about individual stocks. You shouldn't. You should ask me about a portfolio. It's a portfolio that's important. If you go to alpeshpatel.com/shares, you'll be able to see this as well. Now, I've put some more free information on there, so do have a look on alpeshpatel.com/shares. If you scroll down, you will see a whole bunch of stuff like 2025 returns, business owners and professionals, if you're one of those, dentists, doctors, and the like, do have a look at that. So it's on alpeshpatel.com/ and have a look at these, and you go view more, you'll see stuff there. But do have a look at all of those. They're incredibly, incredibly important. I'm going to share some more slides with you. Let me know if you can see more than one file. I'm sharing a load of files. I just want to make sure you can see all the files and not just the last one. Talk a lot about S&P, but not so much about the NASDAQ. Do you have a preference? I thought I talked about both equally. No, it just might be that I just talked more about one than the other, but no. I appreciate you've spoken about the NASDAQ. There you go. Okay, so I think you've asked and answered the question right there. Okay. On that, any other questions that you might have? So, like I said, go on there. Oh, by the way, you might also like the sort of the easy place to find everything that I've got in one place is alpeshpatel.com/links. alpeshpatel.com/links is there. We go, and you should be able to see it there. And there's a whole bunch of stuff. And we've even got the free portfolio performance report there quarterly. So that's up there. That's a new thing. But there's a whole bunch, including getting hold of my books. You can see there as well. And if you've got any questions about anything tonight or the Great Investments Program, just let me know. Oh, here we go. How often is it that a stock gets added to the filtered list? Well, we update the filtered list every 12 months. But the thing about investing is you don't trade your investments every month. The filtered list just means if you were to join today, then that's the list that's appropriate for you. The fact that a month from now something isn't on the filtered list, what we've analyzed is that you're still holding it. So just like Warren Buffett would say, the paradox is if you buy Apple, the fact that the next day Apple, I don't know, somebody didn't buy an Apple phone doesn't mean you sell your Apple stock. You're not trading. In a way, it's the paradox of investing that you're ignoring a lot of information that might come in afterwards. But then you test for that. You say, oh, actually, the entry is that it's in the filtered. The exit is time. Okay, the exit isn't the same as the entry rule, which is a mistake people often make because they're used to reading sheets. Okay, Chetan, been following you for a while, choosing to ignore the noise around AI bubble. despite a couple of bad days among some tech stocks recently. Well, AI, in a way, isn't a bubble. The point is, so I'll tell you the story this way, Chetan, which is really important. And if you're not on my Telegram channel, I highly recommend it, the public Telegram channel, which is here. See that bit there that I'm pointing out on alpeshpatel.com/links? It's really good because I do daily comments. A friend of mine, actually one of the first investors in my hedge fund, was a chap called Tom Singh, who's the founder of New Look, the clothing retail chain. And Tom is a dear friend and a mentor and an advisor, and I look up to him. And Tom asked me about 5 years ago, he said, so which AI companies do you like? And I said, Tom, Microsoft and Apple. He said, what? They're not AI. I said, well, it's their job to ask that question. I buy their shares. They solve that problem. I said, what you'll think I'm going to say to you is, here's a tiny little company. Let's speculate on this that nobody's heard of. No, I'm not going to do that. I said, don't have the firepower to be able to do that. And I was right, because in 2023, NVIDIA came up on our thing, not because it was AI. We didn't know it was AI in 2023. I still thought it was making graphics cards for crypto mining, but it was actually because of the AI stuff. But we waited, not based on the narrative and the story, but on the fact that its P&L, profit and loss account, its balance sheet and its cash flow statements have gone through the roof on its earnings announcements. That's what had happened. So we don't care for narratives. Or even what companies do. We care to make sure that, have they found a license to print money? If they have, we get in. How do we find that? Same place everyone else does, the accounts. But it's not the place people look. What do they do instead? The accounts is like going directly to God, if we use an analogy with religion. Going to tip sheets and all the others, like going to a guru to get to God. Right? Why don't you just look at the P&L, the balance sheet, the cash? That's what our Excel spreadsheet does. It just looks at those. Okay, instead. Any other questions? If not, I will let it go. I will leave it at that. Don't think there are. If they come up after I finish the webinar, then let me know. For those signing up to the program, I put the links up anyway, then thank you. I will send you an email straight after this. Matthew, this will make you laugh. I haven't heard from my IFA for a couple of years, but recently my pensions still under their management and started to recover. So they contacted me for a meeting. Don't think they'll be expecting my thoughts. Yeah, I expect they'll want more money from you and say, look, we've been rather well, haven't we? Well, just remember how the indices have done, and they're going to take credit for that. By the way, like Warren Buffett, I don't take credit for performance of any of our portfolios. I didn't make the money. As he said, Apple made him the money. For me, it's the stocks we invested in that made the money. I didn't make it. And it's the same thing in life. I have the same attitude when people say to me, oh, thank you for doing this. And I say, listen, I was in the right place at the right time, and I had the right opportunities and the education and all the rest of it to be able to help your daughter or son out in whatever way. And it's the same with the portfolio. As Warren Buffett famously put it, and it's not just humility, it is the fact that, listen, the companies we invested in made the money. They're the clever people, not me. All I did was put some money into them. That doesn't take brains. That takes the ability to operate a keyboard. Okay. Thank you very much. I hope you've enjoyed it all. Thanks, everyone. I try to keep it more entertaining. Would you believe my wife has been saying to me all evening, you've got to cancel the webinar. You've got to cancel it. And I'll tell you why. This afternoon, I went to a museum with my son, and they had these flashing lights, and I got a migraine, which I occasionally suffer from. But I anyway. And I said, no, I've sent the invite out. And you might say, why would you do a webinar when you got a migraine? Well, because I love this stuff, but also I love you guys for turning up. Makes me feel wanted. So anyway, I'm going to go. That's why I'm closing it now. Thanks anyway, everyone. I'm going to turn this blasted light off, which is not good when you got a migraine. I just want to thank you all for being on. And yeah, have a look at those links. Thanks, everyone. And I will speak to you soon. Thank you. Oh, and for those who've signed up for the Great Investments Program, I'll send you an email this evening on the onboarding process and everything else. So thank you all. Thanks, Raj. Thanks, James, David, Chetan, Rakesh. And any other questions?